we want to thank the conference organizer for the opportunity to present our work. The title of our paper is Passive Demand and Active Supply, Evidence from Maturity Mandated Corporate Bond Fund. This is a joint work with Lorenzo and Lucas, who is also here. And my name is Tiange. I'm a PhD student from USA Marshall. So over the past 2 decades, we have witnessed significant rise of passive investment in both equity and fixed income markets. So here in this paper, we focus on the corporate bond market. So here we plot the average ownership by different institution type. And here we focus on the red line, which is the passive investor. Here we combine both ETF and index mutual fund. And we can see that there is a clear rise of passive investment in the corporate bond market. So from 2012, it's roughly 3%, and by the end of our sample, it's roughly 8%. So a natural question is, what are the implications for this significant rise of passive investment in the corporate bond market? However, identifies the effect is challenged mainly due to endogeneity concern, as existing method has its limitations. So here in this paper, we provide a normal setting that help us with the identification challenge. Specifically, we document that passive fund demand for maturity display discontinuity around certain maturity cutoff. And using this demand discontinuity, we develop a novel empirical strategy to help us causally identify the effect of passive fund demand shift. And using this identification framework, we try to answer 3 questions. The first one is, how does this increase in demand by passive fund affect the secondary market price and liquidity? The second question is, are there any spillover from the secondary market to the primary market? And finally, what are the real implications? To quickly preview our result for the first one, we find that there is a significant positive price effect and persistent liquidity improvement. And for the second question, the answer is yes. We find there is indeed a spillover to the primary market, leading to lower issuing costs. And for the final question, we find that firms engage in debt market timing, that they substitute away from more expensive bank loan when there is cheaper bond financing option after the positive demand shock by passive fund. And also we find that financial constrained firms are likely to increase investment after the positive demand shock. So our data are quite standard. Our sample is from 2012 to the end of 2021, and we only include investment grade bond in our sample because the market share of passive fund in the high yield segment is relatively small. And to save time, I will skip the literature. So if you are familiar with the fixed income fund market, you will notice that many funds has maturity mandate. So here they usually categorize themselves as short-term maturity category, intermediate-term maturity category, and long-term maturity category. And here we provide a snapshot of all passive funds that has maturity mandate in the corporate bond market. And here let's take the Vanguard fund family as an example. Vanguard has 3 funds that in all 3 categories, and each of them will track a sub-index of Bloomberg investment grade corporate bond index. Let's take the short-term maturity index fund as an example. It will track the Bloomberg investment grade corporate bond index with maturity from 1 to 5 years. And this index essentially will include all investment grade bond outstanding with maturity from 1 to 5 years, as long as it satisfies certain inclusion criteria. And then the goal of this index, short-term index fund, is to mimic the performance of the index. Of course, because of the high transaction cost, fixed income index fund usually don't have to mimic exactly the same holding of the index. Instead, they will choose to use a sampling strategy. The goal is to minimize the tracking error. However, despite the flexibility, the tracking error constraint is still quite binding, meaning that they still need to hold most bonds that are included in the index. And here, one interesting thing is that we find across different fund families, the definition of maturity category are quite consistent. So here, the short-term maturity category are usually defined as 1 to 5 years or 1 to 3 years. And the intermediate-term maturity category are usually defined as 5 to 10 years, and the long-term category is over 10 years. So here, this creates 3 cutoffs: 3-year time to maturity, 5-year time to maturity, as well as 10-year time to maturity. Imagine you have a bond with 20 years maturity when it was first issued. Then it first belonged to the long-term category. As a result, it was eligible to be purchased by all these long-term funds. And then after another 10 years, when its time to maturity is less than 10 years, it will switch to the intermediate-term category. As a result, all this long-term fund will have to sell, and all this intermediate-term fund will buy. And after another 5 years, it will switch to the short-term category. And imagine if the demand on both sides of the cutoff are roughly the same, then there should be no net effect because this will just be a smooth transition of ownership. However, that's not the case in the data. So here in the last column, we compute the total asset under management for each maturity category, and we find that there's a significant gap. So here for the short-term maturity category, the total AUM is over $175 billion, while for the intermediate term category, the total AUM is only $104 billion. And for the for the long-term category, the total AUM is only $18 billion. As a result, when a bond crosses the maturity cutoff, it will have much larger demand from passive funds because it's certainly eligible to much bigger pool of passive capital. And this is the identification we are going to use in our paper. One last thing we want to highlight is that there is no significant change in terms of the mandate. So most passive fund has a fixed mandate. The only exception is that in 2018, one IGSB fund changed their mandate from 1 to 3 year to 1 to 5 year, which we think is a very interesting anecdote. And we're going to mention that later to further pin down our effect is indeed caused from this passive fund mandate. Okay, before we just provide you with a snapshot, now we want to see how this gap evolved over time. So here on the left panel, we plot the total asset under management for each maturity bucket over time. And we can see the ranking is quite stable over time. The red line is the 1 to 3 year, blue line is 1 to 5 year, yellow line is 5 to 10 year, and the black line is 10 plus year. And however, despite the ranking is quite stable, the size of the gap is actually changing over time. So when the gap is bigger, means that when a bond crosses the maturity cutoff, the demand shock will be bigger. Because essentially at any time, when a bond crosses the maturity cutoff, it will switch across different lines. Let's take the 10-year cutoff as example. It will basically switch from the black line to yellow line when it crosses the 10-year cutoff. And another thing we want to make sure is that this demand shock measured by total AUM can actually represent the average ownership per bond. So here on the right panel, we plot the average passive ownership for each maturity category, and we can see the variation roughly mimic the left panel. So the next thing we want to show is that passive ownership indeed display discontinuity around the maturity cutoff. So here we plot the passive ownership on the y-axis, and on the x-axis, we plot the time to maturity. From left to right, the time to maturity decrease, and the vertical dashed line represents the maturity cutoff. We can see that passive ownership increased significantly after crossing the cutoff, and the discontinuity is very clear. If you look closer to the graph, you will see that there are some pre-cutoff trends, suggest that some fund may front run the cutoff, and also there is some post-cutoff trend, suggest that some fund will adjust their holding slowly. This is all expected because first, the crossing event is fully predictable, and second, because passive fund in the fixed income market, they utilize this sampling strategy, which gives them some flexibility in terms of portfolio balance. But however, the key takeaway is that despite the flexibility, the mandate is still quite binding, that after crossing the cutoff, the passive ownership increased significantly. The next thing we want to formally test this in a regression discontinuity setting. So here the dependent variable is passive fund ownership, and the variable we are interested in is the dummy variable equal to 1 if a bond has crossed the maturity cutoff. And here we control for a nonlinear function of the running variable, and we also control for observable bond characteristic. And very importantly, we also control for time fixed fair and bond fixed fair. Effectively, we are comparing the same bond before and after crossing the maturity cutoff. We can see all coefficients are significantly positive, meaning that the passive ownership increase after crossing the maturity cutoff. The magnitude is roughly from 0.2% to 0.5%. So we believe this is economically meaningful given the sample average of passive ownership is around 5.5%. Another important thing we want to check is that there should be no discontinuity for other institutional investors. But of course, if we count all transactions, then the change of ownership will cancel out. However, we want to make sure that for other institutional investors, there will be no systematic discontinuity, because if that's the case, then we cannot attribute our finding to passive fund. So here we test the same regression specification for active mutual fund, life insurance, PC insurance, variable annuity, and pension fund For most cases, the coefficients are insignificant, suggest that there are no discontinuity for this investor. The only exception is for the 10 years, some coefficients are positive, and most coefficients are insignificant or even negative. So this makes sense to us because all these institutional investors, despite they may have their own preferred habitat over the term structure, they don't have the mandate that forces them to purchase or sell bond at specific time to maturity. As a result, they are able to rebalance their portfolio slowly to avoid the high transaction costs. So the conclusion is that the discontinuity is unique to passive funds. The last thing we do with the ownership is that we run a placebo test over other maturity cutoff because we want to make sure that the increase of passive fund ownership is unique to our chosen maturity cutoff. So here we test the regression coefficient for all cutoff from 15 years all the way to 4 years, and we find that all coefficient estimates are insignificant. And interestingly, if we look at the 3-year cutoff, remember in 2018, one fund IGSB, which is one of the largest funds in the short-term category, they switched their mandate from 1 to 3 year to 1 to 5 year. As a result, the 3-year cutoff gap become much smaller after 2018. And this is exactly what we find. We find that the coefficient estimate for the 3-year cutoff before 2018 is very significant. However, after 2018 is much weaker and it becomes insignificant. Okay, so next things we want to check in the secondary market is the price dynamic and liquidity. And here we find that there is a significant reduction in terms of yield spread, such as there is a positive price effect. In terms of magnitude, it's roughly 3 basis point reduction in yield spread. So this is economically meaningful as we only focus on investment grade bond. So our sample average of yield spread is around 100 basis points. If you look closer, they are a bit front running, and also they are start to revert after 4 months and fully revert back in 6 months. In terms of liquidity, we find that there is a significant reduction in bid-ask spread, suggests that there is a liquidity improvement. And interestingly, we find there's no evidence of reversal, seems to suggest that the liquidity improvement is persistent. So next thing we want to check is about the short selling in the corporate bond market, because one way arbitrageurs can correct the mispricing or take advantage of the mispricing is through the security lending, short selling. So here we find that indeed after a bond crossed the maturity cutoff, there's a significant increase in the demand for security lending, meaning that the market realized there's a mispricing and then they increase their demand for security lending. Interestingly, we find that slightly decrease in supply and also there is no significant change in terms of lending costs. And next, we want to see whether or not the short selling capacity will affect the price impact. So here we split our sample based on high short selling capacity and low short selling capacity. Here we split both based on the supply and demand. So here the red coefficient means they have a high short selling capacity, and the blue coefficient means that they have a low short selling capacity. We find that bond with more short selling capacity, they have smaller price impact and quick price reversal. So this is consistent with the idea that arbitrageurs indeed use the short selling as a way to correct market mispricing. So one last thing we want to show in the secondary market is cross trade. Cross trade is defined as transaction happen within a fund family. Cross trade is very important for our setting because remember before we showed that Vanguard has spun across all 3 cutoff. As a result, when a bond cross the maturity cutoff, Vanguard don't necessarily need to purchase all bonds from the market. Instead, they can just purchase the bonds sold by the other fund within the same fund family. So here, the cross trade is regulated by the SEC regulation 17A287, and essentially the cross trade need to be executed as readily available market quotation. However, historically speaking, the definition is quite loose. So as long as they can get an independent third-party price, they can execute the cross trade. And here we are interested in, given the same amount of passive fund demand, passive fund ownership change, how does the cross trade affect the price effect? So here we are interested in the interaction term, and the coefficient for the interaction term is significantly positive. So the interpretation is that given the same change of passive ownership, having more cross trade will reduce the price impact. We believe this result is very interesting because this shed light into the new valuation regulation by the SEC. So this new valuation rule took effect last year, basically this will enforce a much restrictive definition of these readily available market codes. As a result, the unintended consequence is that for all this maturity mandated fixed income fund, they need to get a market code when they need to execute the cross trade. However, because the fixed income market is relatively illiquid, so it's relatively hard for them to get a market code. So the next, we want to look whether or not there is some spillover to the primary market. However, before that, we need to construct an instrument so that we can actually take advantage of the cross-sectional variation. So our instrument is inspired by the investment universe instrument by Kojin and Yogo, 2017 paper. So the difference is that here we can actually observe their investment mandate. So here we know exactly which maturity mandate each passive fund can invest in. So essentially what we do is here we manually collect the benchmark information for all this maturity mandated fund. And then we divide this total asset under management for each maturity bucket by the number of bonds available in each category so that we take into consideration the supply effect. And finally, we assign bond to each maturity category based on its time to maturity. So this graph is a nice illustration of our instrument. So essentially, our instrument is flat except at the maturity cutoff of the 10-year, 5-year, and 3-year. So basically, the key source of variation for our instrument is that a bond crosses the maturity cutoff. And interestingly, if we compare before and after 2018 and focus on the 3-year cutoff, we can see that the jump of our instrument at the 3-year cutoff becomes much smaller after 2018. So this indeed reflects the mandate change by this IGSB fund. So using our instrument, we implied a two-stage least square method. So here in the second stage, the coefficient estimates are significantly negative, suggest that having a higher passive ownership will lead to lower issuing costs in the primary market. In terms of the magnitude, roughly speaking, 1% increase in firm level passive ownership will lead to 20 basis point reduction in the primary market issuing costs. And if we compute the transmission rate, it's roughly 66% transmission rate, which is roughly aligned with what has been documented in the literature. So next, we are interested in the real effect in terms of the capital structure decision and investment. So here on the first two panels, we can see that after the positive demand shock in the passive fund market, we can see there is indeed a significant increase in terms of the number of bonds outstanding and the dollar amount of bond outstanding. So it suggests that the firm are indeed take advantage of the cheaper bond financing option and issue more bond when there is a positive demand shock from passive fund. Interestingly, if we look at bank debt, the coefficient are significantly negative, seem to suggest that firm engage in debt market timing. So when there is a positive demand shock in the corporate bond market, the bond financing becomes cheaper. So they issue more in the bond market and use the proceeds to pay off all these bank loans. The next thing we want to look at is whether or not financial constrained firms are more likely to react differently. So here we look at the interaction term for the passive fund shock and the dummy variable equal to 1 if a firm is financial constrained. And here we find that the interaction term coefficient is significantly positive for CapEx, suggests that financial constrained firm seems to increase investment. And also we find that for the cash holding, the coefficient for the interaction term is significantly positive, and for the payout is significantly negative. So to conclude, in this paper, we provide a novel empirical setting to help us identify the demand shock by passive fund in the corporate bond market. We believe that our method could potentially be helpful for future researchers. And using our identification method, we show that such non-fundamental demand shock have both important financial and real implications. And thank you very much, and look forward to the discussion.